Buying a house. I mean, it's such a big move, right? Literally and figuratively.
Oh, absolutely. It's often the biggest financial step you'll ever take.
And the whole process can feel, well, kind of confusing. Not exactly user-friendly.
Yeah, it's like information overload central.
Yeah.
So our mission today is really to cut through all that noise.
Okay.
We've basically boiled down the key steps and, maybe more importantly, who you need on your team, your support network. Think of this as your roadmap.
A shortcut. I like that. Because the biggest mistake, I think, is people just jumping onto Zillow or hitting open houses right away.
Exactly. Before you even dream about that perfect kitchen, you've got to do some internal homework.
Get grounded, yeah. Resist the urge to just browse.
Right. It means really sitting down and figuring things out. We're talking a detailed priority worksheet.
Especially if you're buying with someone else, like a partner.
Oh, definitely. You absolutely have to agree on the musts versus the wants.
So what's a must?
A must is non-negotiable, like the absolute top price you can pay. Or maybe it's 3 bedrooms, minimum. Or it has to be in a specific school district.
And if you don't figure that out first?
Well, frankly, you're just wasting time. Your agent's time. Getting clear on this gives your future agent the exact target they need to aim for. #FindingYourGuide.
Okay, so once you've got those criteria nailed down, the first person you need in your corner is the real estate agent.
They're kind of your guide through this whole maze, your main source for data, legal insights, your advocate.
They turn all that confusing market stuff into advice you can actually use.
Precisely. And, we should quickly touch on the titles. Agent, broker.
Right. What's the difference? Does it matter?
Well, an agent is licensed and usually works for a brokerage. A broker has more education, can work independently, but the key thing you should probably look for is the designation realtor.
Realtor with a registered trademark.
Yes. That means they're a member of the National Association of Realtors, and they've committed to a strict code of ethics. That ethical commitment is really the important piece for you as a buyer.
Okay, so how do you pick the right realtor? We always say this, but it's crucial. Interview at least 3 people.
Absolutely. Don't just go with the first person you meet or someone your cousin used 5 years ago.
You're not just looking for someone friendly, though that helps. You need competence, rigor.
And local expertise is huge. Can they really talk specifics? Not just general neighborhood values, but like hyper-local stuff.
What kind of stuff?
Trends, block by block, maybe upcoming construction projects, even off-market deals they might know about. That's info you just won't find easily online.
And responsiveness. Test that right away.
Good point. Send an email, see how fast they reply. If they're slow now, imagine when you need an offer submitted ASAP.
True. And check their track record. Have they actually sold homes like the ones you're looking at in your price range in that specific area?
Yeah, relevant experience matters. And remember, this agent often becomes your hub. They connect you to other trusted pros, lenders, inspectors. It saves you a ton of legwork.
Okay, so you've got your agent, your rock. They'll pretty quickly point you towards the next key player.
Yeah.
The lender. The loan officer.
Yes, the money part. This is where we need to talk about loans.
It can feel intimidating.
It can, but let's break it down. First, big hurdle. Understanding pre-qualification versus pre-approval. They sound similar, but they're really different.
Okay, explain that.
So pre-qualification is basically a quick estimate. Like, based on what you tell the lender, here's roughly what you might be able to borrow. It's a snapshot.
It's just a rough idea.
Right. But pre-approval, that's serious. The lender digs deeper. They pull your credit, verify your income, your assets. They actually commit in writing to lending you a specific amount, assuming nothing changes.
And that's what sellers want to see, right? The pre-approval letter.
Yeah, exactly. It shows you're not just kicking tires. You're a serious buyer with the financial backing already lined up. In a bidding situation, that pre-approval can absolutely give you an edge.
Even over a slightly higher offer sometimes?
Potentially, yeah. Because it means less risk for the seller that the deal will fall through later because of financing.
Okay, got it. So once you're getting pre-approved, what kinds of loans are we mostly looking at?
Well, the 2 main styles are fixed rate and adjustable rate.
Fixed rate seems pretty straightforward.
It is. Your interest rate is locked in for the whole loan term, usually 15 or 30 years. Predictable payments, peace of mind. The 30-year is super popular because the monthly payments are lower.
Makes sense. And adjustable rate, ARMs.
ARMs, yeah. They usually start with a lower interest rate for an initial period, like 5 or 7 years.
That's good. So what's the catch?
The catch is, after that initial period, the rate can change. It adjusts based on market conditions. So your payment could go up, potentially, quite a bit.
So who would want an ARM then?
Maybe someone who knows they'll sell the house before the rate adjusts. Or maybe someone expecting a big income jump later who can handle higher payments if needed.
Okay, but if you are considering an ARM,
You absolutely must understand the rate caps. Ask the lender, what's the highest my rate could possibly go? What's the absolute maximum payment I might face? You need to know that worst case number.
that's really important. Okay, and then there are different types of loans, like conventional versus government.
Right. Conventional loans are the most common, usually need decent credit, say 620 or higher, and typically at least 5% down payment.
And if you put down less than 20% on a conventional loan,
Then you'll likely have to pay PMI private mortgage insurance. It protects the lender if you default, but it lets you buy with less cash up front.
okay, and government loans.
Those are designed to help more people become homeowners. FHA loans are really common. You might only need a 580 credit score and 3.5% down. Then you have VA loans for veterans and military.
Often zero down payment for VA.
Often,
Yeah.
yes.
And-
And USDA loans for eligible rural areas, also potentially zero down.
Wow. Lots of options. So just like with agents.
You shop around. Talk to at least 3 different lenders. Get pre-approved by each one. Compare their loan estimates, those detailed breakdowns of fees and rates. Don't just take the first offer. Hashtag the hunt in the contract.
Okay, team assembled, pre-approval in hand. Now the fun part, the house hunt.
Now the hunt begins. Browsing online is exciting, yeah. But remember, those photos are designed to look good.
They hide the flaws.
It can hide a lot. That busy street right outside the window, the weird smell from the basement, you don't get that online.
Good point. Any tips for online searching itself?
For accuracy, sites that pull directly and frequently from the MLS, like Realtor.com, tend to be the most up-to-date. Sometimes other popular sites might lag a bit behind the official listings.
Okay, then you transition to seeing places in person. Open houses, showings.
This is where you really assess things. Feel the space, check the water pressure, listen for neighborhood noise, stuff photos just can't capture.
And when you're at an open house, maybe talking to the agent who's hosting it.
Big caution sign here. Remember, that hosting agent, they work for the seller,
Not for you.
not for you. So be careful what you say. Don't gush about how much you love the place or mention you're stretching to your absolute maximum budget,
Why not?
because they can, and likely will, use that information to the seller's advantage during negotiations. Keep your cards close to your vest.
So stay cool, professional, almost detached.
Kind of, yeah. Your goal is to gather info, not give it away. Ask smart questions instead.
Like what?
Ask if they've received any offers yet. They might only be able to say yes or no, not the amounts, but it's good to know. Ask about the seller's preferred closing timeline. Ask about average utility costs. People forget that one.
Good tips. Okay, so you find the house. Time to make an offer.
Right. Make an offer like a boss, as they say. Remember, this is a legally binding contract. Your agent helps draft it, but you set the limits, especially on price.
What are the key parts of the offer?
Price, obviously. Timelines for things like inspection and closing, and then there's the earnest money deposit, or EMD.
The EMD. That's your skin in the game.
Exactly. It's usually 1% to 3% of the purchase price. You give it to a neutral third party, like an escrow company, when your offer is accepted. It shows the seller you're serious, you're earnest.
And you could lose it if you back out improperly.
Yes, if you break the contract outside of the protections offered by your contingencies, that money can go to the seller.
Which brings us to contingencies. These are crucial.
Absolutely vital. They're your escape clauses. They let you walk away and get your EMD back if certain conditions aren't met.
Like what?
The big ones are usually financing, making sure your loan gets final approval, title ensuring the seller actually owns the house free and clear, appraisal making sure the house is worth what you offered, and of course the inspection.
Now, in hot markets, people sometimes waive contingencies to make their offer stronger. You mentioned waiving inspection is risky.
Incredibly risky. Let's be clear about that.
Okay, unpack that. What's the absolute worst that could happen if I waive inspection just to win?
The worst. You close on the house, get the keys, and immediately discover a, say, $50,000 foundation crack, or massive mold hidden behind a wall, or a completely failed sewer line.
Ouch.
Yeah. By waiving inspection, you gave up your chance to find those things before closing. You gave up your leverage to negotiate repairs or price, or to just walk away. You bought the problem 100%.
Wow. Okay. Message received. Don't waive inspection lightly, if at all.
Please don't. But sometimes a little sincerity can help your offer stand out too.
How so?
Consider writing a personal letter to the seller. Tell them why you love their house, maybe connect your family story to the neighborhood. Sometimes that personal touch can genuinely sway a seller, even against a slightly higher offer, pulling the heartstrings a bit.
All right, offer accepted.
Champagne.
Not just yet. Now comes due diligence. First up, the home inspection.
Right. Looking under the hood of the house.
Exactly. You hire your own independent inspector. They were generalists looking for reasonably discoverable issues.
Like leaky pipes, old roof shingles, faulty wiring, that kind of thing.
Yeah.
Yep. Basic stuff you can see or easily test. But it's important to know their limits. They usually don't check things like septic systems, swimming pools, serious structural engineering problems, or unstable ground.
So if I have concerns about the foundation, I need a structural engineer.
Precisely. Or a septic specialist, or a pool inspector. The general inspector might flag potential issues, but you'd need an expert for a deep dive on those specific systems.
Okay. And after the inspection report comes back, negotiation time again.
Potentially. But be strategic. Focus on the big stuff, safety issues, structural problems, things that violate building codes. Don't try to nickel and dime the seller over like a cracked light switch cover.
Save your negotiating power for what really matters.
Exactly. While that's happening, your lender orders the appraisal.
This is different from the inspection, right? The appraiser works for them.
Lender. The appraiser is neutral. Their job is simply to determine the fair market value of the house. The lender needs to know the house is sufficient collateral for the loan they're about to give you.
The value has to be at least what you agreed to pay.
Correct. It needs to meet or exceed the sales price.
But what if it doesn't? What if the appraisal comes in low? Let's say we offered $500,000, but the appraisal is only $475,000.
Ah, the dreaded low appraisal. That creates a $25,000 gap. The lender will only finance based on the appraised value, the $475,000.
So who covers that $25,000 difference?
That's the big question, and it's negotiable. Option 1, you try to get the seller to lower the price to $475,000.
Option 2.
You meet somewhere in the middle. Maybe you bring an extra $12,500 in cash to closing, and the seller drops the price by $12,500.
Option 3.
You can try to appeal the appraisal. Maybe your agent can find better comparable home sales comps that support the $500,000 price, and you submit those to the lender for reconsideration.
And if none of that works, seller won't budge, appeal fails.
Then you either have to come up with the full $25,000 difference in cash yourself, or if you have an appraisal contingency in your offer.
The contingency saves the day again.
It can. You can invoke the contingency and walk away from the deal, getting your earnest money back. It's your safety net for exactly this situation.
Okay, inspection negotiated, appraisal cleared. We must be close now.
We're in the home stretch. Settlement or closing usually happens about 4 to 6 weeks after you sign the purchase agreement.
What's the big milestone just before closing?
The closing disclosure, or CD. You absolutely must receive this document at least 3 business days before your scheduled closing date.
3 business days. Why is that timing so specific?
It's the law. It gives you protected time to carefully review all the final numbers, the loan terms, your interest rate, all the closing costs itemized.
And what am I comparing it to?
Compare it line by line against the loan estimate you got way back when you first applied for the loan. Make sure the lender fees haven't mysteriously ballooned or the interest rate isn't different than what you locked in.
So, spotting discrepancies before you sign.
Crucial. If something looks off, you have time to question it and get it fixed before you're sitting at the closing table under pressure.
Okay, CD reviewed. What else happens right before closing?
The final walkthrough. Usually within 24 hours of settlement.
This isn't another inspection, right?
No. This is just to confirm the house is in the condition you agreed upon. You check that the seller moved out all their stuff, that no new damage occurred, and critically, that any agreed upon repairs were actually completed.
So, run the taps, flush the toilets.
Test the appliances, check the garage door opener, make sure that leaky faucet the seller promised to fix is fixed.
And if it's not,
your agent can negotiate a credit for you right there at closing so you get money back to handle the repair yourself after you own the place.
smart. Now, closing costs. We mentioned them. How much should I budget?
As the buyer, a rough rule of thumb is expect closing costs to be somewhere between 3% and 4% of the home's sales price.
Wow, that adds up. What does that cover?
All sorts of things. Lender fees, appraisal fee, title search fees, recording fees, maybe prepaid property taxes or homeowner's insurance. It's a long list detailed on your CD.
And title insurance is in there somewhere.
Yes. Now, there are 2 types. The lender will absolutely require you to buy lender's title insurance. That protects their investment if some ownership claim pops up from the past, like unpaid taxes from a prior owner.
Okay, that protects the bank. What about me?
For your own protection, you need owner's title insurance. This one is usually optional, but highly, highly recommended.
Why? What does it protect me from?
It protects you from hidden title problems that could surface years later. Things like forged signatures on old documents, unknown heirs claiming ownership, errors in public records, things that could challenge your right to the property. It's a one-time fee for peace of mind that lasts as long as you own the home.
Makes sense. One last warning, I think. Something about finances between pre-approval and closing.
Yes. Critically important. Once you're pre-approved and under contract, do not mess with your finances. Don't go buy a new car. Don't open a bunch of new credit cards. Don't max out the cards you have.
Why not? The loan is approved, isn't it?
It's conditionally approved. The lender's underwriter does a final credit check and financial verification right before closing. If they see you suddenly took on a big new debt payment or your credit score drops significantly, they can actually pull your loan approval at the last minute.
Seriously, right before closing.
It happens. Keep your financial picture stable until after the keys are in your hand.
Wow. Okay, so recapping the journey for everyone listening. It's complex, yes, but totally doable if you break it down. Know your must-haves first.
Build that strong team. Agent, lender, inspector.
Shop hard for that loan, get multiple offers.
Understand your contingencies and use them wisely, especially inspection and appraisal. Don't waive them lightly.
Review that closing disclosure meticulously.
Yeah, when you think about just how much detail goes into one single home purchase, from figuring out an FHA loan's requirements to arguing about appraisal comps, it really shows why having good advisors is so valuable. But remember, they advise, you decide.
Right. The ultimate responsibility is still yours. That brings us to a final thought. We talked a lot about the experts you need. Buying a house takes patience, sure, and hard work. But maybe more than anything, it requires trust. How will you ensure that every single relationship you build on this journey, from your agent to your lender to your inspector, is truly built on that foundation of confidence and competence? Something to think about.